Hello everyone, I'm Victoria and thank you for joining me today to go over the website that I produced along with my teammates Sunny and Jackie, dedicated to exploring and backtesting a market-neutral pairs trading strategy. So let's start at the top. When you land on the home page, you'll see a clean navigation bar linking to the home about indicators, sample pairs, and interactive analysis. If you ever want to pick at the code, the little GitHub icon in the corner will take you straight to the repository. For today, we'll dive into each of the sections in turn. On the About page, you will find an overview of the pairs trading. Simply put, pairs trading is a market-neutral approach. You go long one stock and short another based on the idea that their prices move together over time. When their price relationship diverges, you bet on convergence, buying the cheap assets and shorting the expensive one. The key takeaways here are the mean reversion. We expect prices to return to their historical relationship. And we have the statistical rigor. We use techniques like correlation and co-integration testing to find the reliable pairs. And we have the risk control. Dollar neutral sizing, stop loss rules, and maximum holding periods keep risk in check. Next, let's move on to the indicators. This page dives into the numbers behind the strategy. So for the correlation, it measures how tightly two price series move together. Typically, we look for values above 0.7. And we have the co-integration test. It measures there is a stable long-term relationship. We want that p-value below 0.05. For the ADF, that tracks that the log price spread is stationary, another requirement for mean reversion. And for the half-time calculation, it estimates how quickly deviation revert, guiding our maximum holding period, ideally between 5 to 60 days. So finally, we calculate these scores of the spread and address entry thresholds based on the market volatility using the VIX index. Each indicator has a clear definition, the statistical method used, and the interpretation threshold, so you can see exactly how the strategy decides when to trade. Moving on to sample pairs. The site works through a real-world example, AutoZone versus O'Reilly Automotive. Here's the flow. So statistical analysis shows a high correlation around 0.95, but co-integration tests and ADF remind us to watch for non-stationarity risks. So for the trade implementation, it sets parameters, $1 million in capital, 100 shares per lag, a 5% stop loss, and dynamic Z-score threshold between plus minus 2.0 and plus minus 3.0. And also for the backtest result, it displays a blotter of individual trades, a daily ledger of portfolio value, and key performance metrics. Total return of about 1.5%, an annualized return near 36%, a Sharpe ratio of 0.43, and a maximum drawdown of roughly 34%. This case study highlights both the promise and caution points. Strong returns can come with volatility, so risk management is critical. For the interactive analysis part, you can really get your hands on by hit the launch interactive analysis button. So this opens a Streamlit app where you can enter any two ticker symbols, configure your parameters, and hit the run analysis button. So the app retrieves the historical data, price data, runs correlation and co-integration tests, calculate the Z-scores, simulate the trades, and return charts and performance metrics all in real time. So whether you are learning quantitative trading for the first time or refining an existing strategy, this web is designed to be both educational and hands-on. We encourage you to dive in, try all your ideas, and see what insights you can uncover. Thank you and happy trading.